All right, I'm sure I'm going to get asked this again, but is this being recorded? Yes, it is going to be recorded. Somebody will show up late probably and say, hey, is this being recorded? I missed the first half. But yes, it is, and it's not going to help those guys that show up late. So we'll probably answer that question again. But something I always say is watch this again, whether it's this webinar when we send it out to you. Watch it again because some of the nuances may slip by you. I don't care if you're a newer trader or a savvy trader. I have specific guidelines that we need to follow in order to implement this strategy. And there are, some hard line ones and some that are a little bit softer, but something we will learn in this webinar as opposed to going online is specific strike locations, the days to expiration that are the best, and the environment specifically in and around this underlying that need to be there in order to implement this strategy. It's a little bit strange right now in these times with the environment, but we'll talk about that when we get there. But this is on the broken wing put butterfly. And if there's nothing you remember outside of this broken wing put butterfly, then never do this for a debit. Then I'm all good with that. Because that is one of the most important things to remember about this. We're going to be adding risk to one side. Therefore, we need to be paid off for the risk that we're taking on the other side. Therefore, we're going to do this for zero money outlay or receive a credit into our pocket. All right, but before we get on with that, let me get a couple of things out of the way. My name is Eric Wilkinson, and yes, you very well may recognize me from mainstream media, where I've talked about everything from the economic and geopolitical environments and how that impacts the overall markets. Well, I do that same stuff in my daily market commentaries, which I do every single day. I talk about my trades, but that's the crux of what I do. But I started out trading in college with some money I had earned. After graduating college with a finance degree, I actually switched over from a psychology degree into finance. I graduated with a finance degree, moved straight to Chicago, and started working on the floor as a runner or a clerk, one of these guys down here, and then moved up into the pits and continued trading. So I've been doing that for about over 25 years. I've traded everything from stocks, financial futures, commodities, and currencies, and options on all those products. But hey, we got to go over this disclaimer, you guys. Remember, everything I talk about in these webinars is general commentary, does not constitute investment advice, all right? I am not here to give you guys or solicit you guys different trade recommendations, okay? I'm here to only talk in specifics about option strategies and how we implement those. And then how you implement that against or around your market assumption is up to you. We have to be big boys and girls here. And remember, please remember, past performance of any trading system or methodology is not necessarily indicative of future results. There is the possibility of losing money when you're trading, and you have to keep that in mind. All right. So I can't give you guys investment advice. The reason why is because not only am I not your financial advisor, well, if you have a financial advisor or if somebody is giving you financial advice, they need to know your risk parameters. They need to know what's in your portfolio in order to make sure that it is appropriate for you. And I don't have that luxury, so I do not believe in giving you guys trade recommendations, despite the fact that your assumption might be, as good, if not better than mine. So keep that in mind as well. What we're trying to do is implement these strategies around an assumption that we come up with. But the idea here is we could always be wrong, but we want to increase our probabilities of success by implementing these in the best way possible. All right. So I've come up with several, like I said, mechanical ways to implement different strategies around an assumption. And the idea is that the probabilities are much better with the way that we're going to be setting these up. All right, and I'll explain how that works out. Hopefully that will stick in your mind, make sense to you. If not, reach out into the questions box. I'm more than willing to answer any questions as we go along. Also, follow me on Twitter at Wolfman's blog, or our parent company at ProTrader Strat for all kinds of market-related stuff. And our Facebook page is at protraderstrategies.com. If you want to see those daily market commentaries, we don't throw out every single one of them, but we do put out a lot of content on Facebook. So check us out there if you want to get quick access to some of my market commentaries, daily market commentaries. All right. So, but I do a market commentary every single day for our premium subscribers. All right. So this is the broken wing put butterfly. We did the call butterfly last week, and it seems that there was a little bit of confusion, and it may have been on my end. I thought I was doing the call butterfly last week, but we sent out a notice to everybody else that it was a put butterfly. So we just flipped the two around to do that. So sorry if there was any confusion for anybody last week. All right, so the put butterfly is a skip strike butterfly, is what some people will call it, or a wounded wing butterfly. I like to call it the broken wing butterfly. Why? Because that's what we called it on the trading floor. And the difference is, you have a put or a call butterfly. I'm not talking about the iron butterfly, but this is a put or a call butterfly. What we do is we're basically going to be buying a put on a regular butterfly. You go kind of equal distance, and you're going to sell two puts, right? And then you buy a put further down the option chain. The way it gets the butterfly name is because it looks like that. That's the idea, is that's how you create a butterfly. Well, if we look at this as being the option chain, right? And, this is, let's just say, the 100 strike, for lack of a better, we go 95, 90. That's an equal distance butterfly. They're equally distanced from one another, right? Five points in between. Well, what we do with the broken wing put butterfly, we do a synthetic short put spread in there. And that's kind of what creates this whole thing. And not to confuse anybody, but the way it looks is we would have the 100 puts here, the 95 puts here, and then we would skip that 90 strike. So we're long that one while we sell a put at the 90 and then buy it out here at the 85. So the 85 strike is a little bit further away. So you're basically selling two puts here, right? You're buying a put here, and you're skipping the strike and buying a put here. So the butterfly looks a little funky. That's where it's got the broken wing, okay? Selling two there. Does that make sense? Looks like you are buying two and selling one. So I'm sorry, I tried to do two P's there for selling two puts on that. So what this is remember, we had, in this example over here, we've got the 90 strike. Well, that's the one we had bought. When I said that there's a synthetic put in here, if you think about it, if I sold a 90 put here, well, then that means that these two cancel each other out, right? And then you buy the 85 put. That's not to try and confuse anybody at this point, but that you're going to hear me talking about this synthetic put right here that is embedded into this strategy to create the broken wing. Because remember, we don't have this 90 put on this side, right? That one's canceled out in a sense. And what that does is it allows us to do this strategy rather than over here. This strategy would be a debit, right? And this one, we want to do it for a credit, all right? Because this short synthetic put spread that I'm talking about here, this synthetic short put spread finances all of our risk to the upside. So we don't have to worry about it rallying in a case. Yes, we do add a little bit more risk to the downside. There is more risk here. We have more larger amount of risk there, but let's go back, sorry. We add risk to this side in order to eliminate risk here, all right? So we should have no risk up here to that side. I know I'm doing a lot of drawing, but that's the idea. And I'm mentioning that right now only because I'm going to keep talking about it. And hopefully by the end of it, the way we are building this strategy out, you will be able to see it a in several different ways and be able to visualize it. All right, so it's really a market neutral strategy because we want this maybe to go down just a little bit, but not a whole lot. And bullish, why could it be bullish? Because we, like I said, the risk to the upside is zero if you build it out correctly. That's why I said if we're adding risk to the downside, we want to eliminate the risk to the upside. And sometimes we're going to be able to build this strategy out, like I said, for a credit. And then therefore, if we get a credit on this, this strategy can go to the moon, or this underlying can go to the moon, and we'll get to keep that original credit that we collected. All right. Now, the big money, obviously, is if it stays market neutral or moves slightly lower from the way that we were going to set this up. But the idea is you can be, all right, I think it's going to stay right here. I believe it's going to stay right here. I'm not worried about the downside in this underlying. I think it's going to go higher, possibly. I'm worried about the upside. With a regular fly, you're thinking, I'm just completely neutral. With this one, you're thinking, okay, well, I'm neutral, but I'm a little worried about the upside. All right, so if you have that, like, I'm a little worried about the upside, you'd want to break that wing on a butterfly. So the idea is you're going into it, I'm neutral, but you're kind of like, I'm worried about the upside on this. And that's the only thing that could really make this strategy go bad, is if it's gonna rally. And therefore, what you do is you add some risk to one side to eliminate the side you're worried about. If we're adding risk to the downside, we want to eliminate the risk to the upside. Absolutely. Did you say finance the risk to the upside? Yeah. By selling that short put spread, remember in that example that I showed you, I think it was on this page. By selling this 90 put to buy the 85 put, that's the extra risk we're adding, okay? A short put spread. But by that credit you would receive synthetically, you're going to get a credit kind of for that. Visually you're going to have to picture, well, all right, I get a credit for selling a put spread, right? Anytime you sell a put spread, you're going to get a credit for it. Well, that credit here finances the upside to eliminate that risk, okay? And I'll show you that. I'll break it down here a little bit further as we go along. All right, so skip, strike, butterfly, if you want to call it that. I like to call it broken wing, like I said. But you must have a market assumption. You can't just be like, all right, I think it's bullish or I think it's bearish. You need to have some kind of directional assumption. In this case, we're thinking it's neutral right now. We think it's going to like stay right here, but we are worried about the upside. I'm a little concerned about the upside. I think the market, I think this market has a sideways trending movement ahead of it because there's no news coming out, and things of that nature, however you come up with your assumption. But the idea is, yeah, but this market's just been rallying like crazy, so I'm a little bit worried about that upside. I'm not worried about the downside because I'm just, I'm content with that, or however your assumption is. You're just worried about the upside, but you believe it's going to trade sideways. All right. And we want like I said, we want high implied volatility. The reason why is because, in a low implied volatility, our broken wing butterfly is going to kind of look like this. Right. And then in high implied volatility, our wings are going to be a little bit bigger. Okay. And what that does is it gives us more wiggle room to be right. Okay. That's what volatility does. Remember, what volatility does is it inflates those premiums, right? We see volatility going up and the premiums go up. It's because people are buying options without regard to value in some cases. All right. They're just, fear is implied volatility really a lot of times, whether it's fear to the upside or fear to the downside, it's the buying of options. So when they're buying a lot of options, those premiums get juicy. All right. That's when we want to take advantage of high implied volatility. And we always want to collect a credit or do it for zero, right? Zero outlay of money. The reason is because if we're going to add risk to one side, we need to be paid for that in the other side. Yes, you can, if you don't follow some of my rules here, you will be able to do this strategy for a debit. And that to me doesn't make sense. You might as well just do the regular butterfly. Don't add risk to one side and not get really paid for it on the other side. The idea with the broken wing butterfly is you eliminate risk to the upside, right? Just like in the call butterfly, broken wing call butterfly, we are eliminating the risk to the downside. Okay? All right. Traditional butterfly, you got to nail it. Like you can't be wrong on either direction. You're going to have lower margin requirements, but you have to nail the number because you're going to have risk on either side. If you've ever traded a butterfly, they can be very frustrating. They take a long time to develop and make money on, and you got to nail that number. With this one, we're transferring risk, like I said, from one side to the other. We have a higher profit potential, and of course, when we have a higher profit potential, we are going to have a higher max loss. It's risk reward, right? If you have a higher reward, you have a higher risk, right? And we protect ourselves from the downside move. We're not worried about, I knew I was saying that wrong in the last slide. We're going to be protecting ourselves from that move. All right. So without further ado, let's get on with it. How do we do this? I've kind of mentioned this. I like to do it. Some people will tell you to do it in the money. You can go slightly in the money. I would not go massively in the money with this. We want to do it. I like to go with just the at the monies. All right. Maybe, some people could call it out of the money, but basically the first strike at the money or just slightly out of it. If you're, more directionally, like you think it's going to maybe trade down and sideways, then you'll just slightly adjust it. But for the most part, you're going to be starting right at these at the monies or slightly in the monies, okay? And then we're going to go out. If it's like a $50 stock, we're basically going to go out $2.50, $2 to $2.50, and then go $4. We're going to skip a strike there, and I'll show you how to do that here in a second. Max profit is the higher strike minus the middle strike plus the net credit, all right? Max profit. So what this looks like is if, the market's trading right here, it's going to kind of look like this, all right? So we're going to eliminate that risk to the upside, but the idea is our higher strike, which is this one here to here, plus the credit. And the idea is, let me pull up my platform real quick. I don't want to confuse anybody right away. It seems like there's some questions on this coming up already. Okay, so let's just take Lulu. I was trying to make sure that Lulu fit the rule before the close here, and it was pretty close. All right, so Lulu's trading 67. Well, you can tell we're either going to have to pick the in the monies or the out of the monies. So it's going to be a pick them. You can't just do the out the money. So I like to give myself a little bit more room to the downside. So the idea is a regular butterfly. We'd be doing this 265s, selling the 250s, and then doing the 235s, right? 250s twice. All right. So that's your regular butterfly. And if you kind of go and look at this on the platform, you can analyze the trade. We get rid of that one. All right. You can see that you have risk to the upside because it goes below zero. That's your risk to the downside and your risk to the upside. Sorry. So we have risk on both sides. Now, what I was saying is if we go over here to this trade platform, I bought this 235 right here. Well, what happens if I do a synthetic short put spread in there. Well, if I sell now, actually it's going to mess it up. The normal one is selling those twice and then doing the 235s, right? So that's our normal one. Now, the quantities are going to default to 10 on this. That's why. All right. So I've got this equal distance butterfly. Now, this is where I was saying if we have sell a synthetic short put spread in there. Well, I sell the 235s, that gets rid of them, and then buy the 15. So I got to go to the 20s and buy those, right? So now I've done it for a credit. So by adding risk, get rid of this one. So I added risk to the downside by selling that short put spread. That short put spread is the risk, right? When you're short a put spread, that's adding risk, but it's financed all of this upside, right? So if it goes higher, this is where I was saying, I think it's going to stay right in and around here. You know, that's where I think it's going to go to. If you thought it was going to stay right where we are currently trading, that's where you would go to the in the monies. But and you're worried about the upside, you'd be able to collect a credit if the market didn't stay neutral. But vice versa, you would be adding risk to the upside as well, right? So if you thought it was going to stay right here, then obviously you could go to the in the monies and do the 280s. Sell 2 of the 265s, and then go $15 lower. Sorry, I'm going to have to close this thing out. You're going to have to go $15 lower there. Now the dog's barking in his sleep. And buy that one, all right? So that would be if your assumption was completely market neutral. You thought it was going to stay right here at the current location on that, all right, which is Wrigley. All right, so if you thought it was, that's where you would go in the money. If you thought it was, hey, I think Lulu, you're looking at the charts. I think that Lululemon is going to continue to trade sideways from here, all right? You know, it's kind of reached a little bit of a top here. Maybe you think it's value is right in and around here, and it's going to kind of trend sideways. All right. What is this synthetic strikes? Okay, Eric, my friend, you are making very little sense. Raj, all right, let's go over this again. And I don't know where I'm not making sense, but I'm sorry, I got a little bit verklempt with my dogs barking and somebody hit me up on Teams, my trading buddies. All right, so I know. Take focus, he says. Focus. You block it all out. All right. So let's start with the synthetic. All right. So if I was going to do this one just at the monies, let's just say I'm picking the 265s because it's a pick 'em here. All right. So bought the 265s, sell 2 of the 250s, right? We're just building a regular butterfly. And then we go $15 lower and we buy the 35s, all right? So I've got my equal distance butterfly here, all right? So if I go over and I look at the Analyze tab, we can see that that is what a normal butterfly looks like, all right? So now let's go back to the trade. Here's the synthetic put. That's a regular one. Well, if I sell a synthetic put spread, it's just the idea of, all right, now I sell a 235 and I buy that 15 strike lower, the 220s. Well, that's where that synthetic short put spread is. All right. So that gives me the credit. All right. Now let's analyze the trade because somebody's asking, how do you make money on this thing? Well, if the underlying stays sideways on this, all right, or slightly move lower. The idea is right here is where we make the money, and that's when it is pinned at that 250 strike. So the idea here is, right, we're currently trading, current market is right here, all right? So if the market starts trading slightly down, what happens is we have on a long put spread from the 265s. We're long a put here, right? We're long the 265 puts. So as the market goes down, this put increases in value, right? And then we're short 250 put here and short another 250 put and short another 250 put, right? So we're short 2. That's how I'm going to write it, 2 there. So as this goes down, the short put spread gains in value. The way you make the most money is if the market trades right down to this 250 and these expire, these 2 puts, short puts expire worthless. That's how you're going to make the most money. Because this long put spread going down increases in value. This whole put increases in value. This one expires worthless. This one expires worthless. So this one increases in value by how much? $15, right? If it goes down by that $15, all right? So at expiration, our max profit is, like I said, the higher put minus that short put, which is $15, plus the credit received. So our total max profit on this would be $15.83. All right, that's our max. Why? Because this put goes down, these expire worthless, and this long put at the 220 strike right here, we're long another put here, the 220 puts. All right. So you start, as this market continues past the 250 put, or short one. It's getting a little confusing there too, probably. But as the market continues to slide here, come on, eraser, work for me. Let me fix this for you so I don't confuse it. That eraser, what's going on with my eraser? Oh, I've got the wrong thing here, sorry. Let me do this. All right, so like I said, these are we're short a put here at the 250 strike, short a put here at the 250 strike, same strikes, right? So as we come down, like I said, you're going to gain in value. Well, as soon as it goes past the 250s, well, these short puts start increasing in value. That starts hurting us. Yes, this one is going to help us a little bit, but you can see that this $15 put spread that $15.83, as it goes down, starts getting eaten away as this becomes more and more negative, right? So our break even is going to be basically at 234.17. Does that make sense there? Your wing is 15 on the long, yes, and your other one is 30, yes, correct. How do you decide on the 250 as the shorts? And what's Lulu price at this time? Lulu's price right now is trading right now at 267.58. Where would the synthetic short be on the analysis risk profile? Well, right here, it's going to be right here at the 235 area. So right here, about 235 is where our synthetic short put is. Because normally we would be long this put, so then you got short it and then long the 20s. Does that make sense? Would this be good for SPX, IWM, or the Qs? Absolutely. You can do this on the ETFs or, yeah, the ETFs, any ETF stock. You can do it on futures. I actually did this with IWM last week with the call one. That was my example on that one. And how did I decide on the 250 for the shorts? Well, really, let me get rid of this. So basically what I was doing here, when I picked this one, I'm looking at it for $15. I just kind of looked down here and knew that if I sold this, I just kind of knew that if I went down about half the distance of what the price is, it gets a little confusing. On a $50, I've been doing it for a while, so on the $50 ones, you're basically going to go about $1 wide. $100 stock, you're going to go somewhere about the $2. This is a $200, $250 one. So I figured it was probably about $15. That has to do with a little bit more, you know, of my doing this forever, right? But basically the idea here is a $50 stock, you're basically going to start out with about $1 wide, which is why I don't really like to use the $50 ones. It's pretty tight. But a $50 one, you're basically looking at $1. And if you get the 50-cent strike, you try the $1.50. $100, you're going to basically be looking at a, you know, somewhere between the $2 and the $5 strikes. And then, you know, it's kind of a multiple of that. Traditional one would be 235 times 2 short, the 245 long, correct? Traditional, yeah, traditional would be, yeah, depending on your strike location, you're saying that a traditional one, you could be looking at out of the money and do it $10 wide. So buying this one, selling 2 of these, he's asking, and then a traditional butterfly would look like that. Yes. You know, you could look at it where then I sell this one, right? And then I go a little bit further out and I buy that one. So that's the same thing. That's that synthetic short put spread. So if you want to be a little bit more directional, you can absolutely do that sometimes. It doesn't always work out that way. It usually works out pretty well with the at the monies, but this one has pretty high implied volatility right now. But yes, that's the same idea. Buy this one, sell that one twice. That would be a traditional butterfly. But I want to do a broken wing. So I'm breaking the wing right here by selling that put and then going a little bit further out and buying it. I'm still able to do it for a credit. I added more risk to the downside, but we could look at it and say, analyze, get rid of this one. All right, so it's very similar. It's a little bit steeper here, but yeah, you got a big credit. And if it stays higher than where we are, you get to keep that dollar. If it comes back down to right there at the 245s, that's where you're going to make the most money. Yes, when the stock goes to 235, if the stock continued down to 235, that's basically around where our break even is. It's actually going to be 234 should be our break even on here because we collected the dollar, right? So the long put spread, the 255, 245, the long put spreads are max profit. All right, plus the credit received. So our break even is when it starts, you know, that long put spread's already full boat when we get down to 245. So as that goes further, the extra short put starts hurting us. All right. And as the market goes down, then once this long put spread from 255 to 245, you know, pays off the downside, it's going to be basically a 234 or 235. But you got to remember we got this credit also. So that gives us an extra dollar of leeway to the downside. Does that make sense? Hi, I was under the impression in order to be a synthetic put, you had to be short the underlying stock. Am I wrong versus just the short put position? Well, what I don't know if you're confusing with like a synthetic short stock position. This is just saying, and maybe I'm confusing some people with that, but the idea is, you know, there is a synthetic short put spread in there only because with the traditional butterfly, you're starting out at the 235s, right? You're starting out just like this. All right. And the idea is you get rid of the 35. Whoops. Get rid of the 35 and you switch it to a 25. So basically that short 35, 25 put spread, you're collecting a credit of, we can check, if I just did it, well, let me get rid of this. If I just sold the 35, 25, it's an extra $1.82 credit, right? If I just sold the 35, 25 put spread. So that's the synthetic put spread we're adding to this strategy. That was, in this case, we were looking at the 255, 245, 235, right? 255 twice, or sorry, 245 twice, right? That's a debit. Now, the idea is if I sold the 35s, bought the 25s, that extra $1.80 credit, right? It went from an 80-cent debit to a $1 credit. Does that make more sense, you guys? All right, perfect. So let's just run that by because that seemed to resonate with a lot of people. So if I were just to sell a put spread in this strategy, it's $1.82. That's just a put spread. And that's the synthetic put spread I'm talking about. With a regular butterfly, looks like this, where we sell the 255s, buy the 245s twice, sell the 235s. All I'm doing is adding that put spread that we just showed a minute ago for $1.80, and that brings us from an 80-cent credit to $1, or 80-cent debit to $1 credit. Yes, so your break even will be that 235 strike minus really the $1 credit because that helps us. So basically my break even is going to be 234. Because the idea is I am long this put spread. I'm long this put spread, right? So as the market comes down, once this put spread gets to 245, it's going to be worth a total of $10. Forget about the debit. It's going to be worth, it's going to be looking at being worth $10 at expiration, right? If at expiration it was trading 245, I would be looking at $10 right here. But then as it goes a little bit further, it goes down to 240. Well, it starts eating away at my overall credit. So you're saying you start out with a butterfly and turn it into a broken wing butterfly by changing the put spread. Yes. I tried to read that a little bit different so everybody else would be able to understand it, but yes. You're basically starting out with any regular butterfly. This one would be, we could do it to 65, 55, 45 also, right? It's a debit. It's always going to be a debit when it's equal distance butterfly. And then what you do is you just same strikes. It would be $10. I sell that one and go down to the 235s. That's where the confusion was. Got it. All right, perfect. Sorry about the confusion on the synthetics there. But, I want you guys to be able to picture it, right? That not only is it a synthetic put spread, but that is the extra risk we're adding to the strategy, right? That's why if the market goes down, when we were over there at the Analyze tab, that's why if the market goes down, our risk is more to the downside. But that short synthetic put spread that's in there finances us to the upside to make it free. We get to keep that credit if it goes higher. We want max profit, which is, it pins right there at 245 at expiration, that would be the best case scenario in this particular strategy. Okay. If you just started with a broken wing, then you would not have to change anything. Absolutely. If you were right, I'm trying to give you guys a visual so that everybody pictures the concept of this. The idea is that if I went, 265, bought the 265s. If I bought the 265s and went to the 250s, right? I know that's $15. So the broken wing I know is just double that distance. All right, that's the perfect way to build it out. Yes, the more and more you trade around this, you could add a little bit more risk to the downside. You usually won't be able to get away with just going the 225s or something like that. You would not be able to come out here and buy this one. Well, actually, you could in this case. Still worth a credit as long as you're getting a credit, right? This isn't completely the broken wing butterfly. You can see it's a little bit off, right, on the distance. We went 15 and 25. Should have gone to the 220s to make it a real example. But in this case, I was still able to do it as a credit. So you can play around with that a little bit. I have no reservations saying that you have to exactly double the distance on the downside. That's not a guideline I would say you need to have. My main one would be if you don't do it the correct way and aren't equal, doubling that distance by breaking the wing equally, that you're at least doing it for a credit, because there's no sense in adding risk to the downside if you're not getting paid for it on the upside. Right? That's what I said very beginning. There's nothing you walk away from other than I've got to do this for a credit, or what I was saying was zero. The worst case scenario would be zero. I would not do it for a debit. Don't do it. If you build this strategy out and it says, okay, you can do this for a 4-cent debit, don't do it. It's not worth it. Put it in at zero and see if you can get filled there. All right. All right. So we got the max loss. Max profit is that skip strike minus lower strike. We saw that in the Analyze tab, right? Where we were going over to that. Let's just check out the Analyze tab. So we talked about this. Our skip strike in this case was the 235. So basically, as soon as it goes past that skip strike, the 235 to the long put, we can't lose any more than it going past that long put. So basically, the skip strike, the 235s to the 225s is our real risk there. So that is $10. And we got to keep a credit. We got to keep this credit. So basically, our max loss in this case would be $9. And you can see it lines up with 900 in this case, because everything is multiplied by 100 when you're using options. And our upside, you can't do wrong. We get to keep that $100, right? So it's our skip strike that it's basically the risk is our synthetic short put spread minus the credit, right? All right. All right, our break even is the skip strike minus the credit. And we've kind of went over that again, right? It's that skip strike. Skip strike comes into play again. So our break even is going to be, in this case, we're skipping the 235s. Yeah, I did this one even. We're skipping the 235s. That's our skip strike minus the dollar. So our break even is 234, right? Because this, remember, the long put spread, which is the 255, 245, gains in value. So that's worth $10 right here. It's worth $10. but then the short put spread, which is the 245 to the 225, starts, getting hurt as the market goes down. So as the 245 start gaining in value, it starts eating away at that build up from our long put spread. See, this is why I have you guys ask questions while we're going through this. All right, now let's go back a little bit because we spent a lot of time on that. So I'll try and rush through this on this stuff. Picking the right underlying. What we do is we're coming up with an assumption, right? So the idea is, like, you're looking at the markets. I'm just kind of, everybody has their platform, or you're watching TV or whatever happens, and you're flipping through your watch list or whatever. You're just kind of maybe even looking at charts, and you're just kind of banging it away. And all right, I think it is, you're kind of going, okay, crude oil, blah, 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 Ulta, IWM. You could even be like, all right, IWM, I'm worried about the upside, but I think it's going to stay right here. I think the market is going to kind of trade in and around here, but I think it's probably going to pin right in here. However you come up with your assumption, I think it's going to come back down into this, between these two Fibonacci's maybe, okay? Let's say that's our market assumption. So we could look at it like that, but I'm worried about, it continuing in that trend, right? So that's the idea. I think it's going to stay here. My idea is, I think that this market is going to trickle back down into this area, and we're going to trade right in this area between those two Fibonacci's, right? So we're kind of looking at, like, that strike at the 230s or whatever. All right, let's delete this. Trade IWM. There's my other broken wing butterfly. You can see that's not working out very well. So what we would do is we're looking at the 235s, 234s, just at the money here. So I'm going to be going, I'm going to buy these, and then I'm going to go $5 lower. So I'm going to sell the 229s twice, and then I'm going to go $10 lower. And buy the 19s. Right? So I went $5 and then $10, and I get to do it as a credit. Now, if the market goes down to that 229 area, if it goes back down to this 229 area, that's where I'm going to make the most money. So if my market assumption is, it's going to trickle back down here, but I am worried about it to continue higher, then, I want to be paid for it. But I don't think we're going to go back down into this area. I don't think we're going to sell off. Worst case scenario, it might come down and trade, or I'm out below that area right there. Boris is in UK, Robin Hood country. Greetings. All right. Are you worried about the upside when it is always going to be positive on the risk profile? Am I worried about the upside? I don't know what you're really talking about there, John, if you could expand on that. Why are you worried? Listen, I'm just saying, maybe not worried, maybe that's the wrong word. Maybe I'm thinking I'm not concerned about the downside, or I don't believe this market is going to go down. But the idea is, if I was completely market neutral on this, then I'd just do a regular butterfly, right? But the thing is IWM, I'm thinking in this case right now, create, an assumption. I can create an assumption for anything, right? I can come up with any way to build out an assumption to make it fit the strategy to teach. That doesn't necessarily mean that's what I believe in real life. But the idea would be, if I was looking at this and I had the assumption that the market was going to want to trade in and around here, but the concern is that we've got a trending market, right? We should actually be worried about the downside, right? Well, listen, I'm not going to tell you what's right or wrong on a market assumption, because your market assumption might be very, very well right. You might be right. The risk may be more to the downside at this point. If you watch the daily market commentaries, you've been seeing that I think the risk is more to the downside. But I'm just saying, if, when you're looking at the markets and you're saying, I think that this market is going to trend sideways, but I'm also concerned that maybe it's going to, however you come up with your assumption, right? Concerned about that gap getting covered, right? If it comes up and covers that gap, or fills in here, or whatever, or gaps to the upside, right? You're concerned, you believe the risk is more to the upside than the downside. So you want to eliminate that. I'm not here to say how we come up with our assumptions. So, but with that being said, like I said, picking the right underlying, I come up with that assumption with IWM. What I need to do is, if it's a stock over $100, I need to make sure that there is a tight bid-ask spread. So on the ones that are closest to 35 days to expiration, it needs to be, my rule here is, you move on a stock over $100. If it's greater than $100 stock, we move the decimal place 3 ticks to the left. So 13 cents would be my rule. So we take that the idea of 13 cents, come back to these options that are just out of the money, all right? And we look at between the bid and offer, all right? So we've got 13 cents we're talking about here. So between the bid offers here, we need to make sure it's tighter. This is 4 cents. This is 3 cents. So that fits that rule, okay? This is, anything over $100 stock. If it's greater than $100 stock, it needs to be less than or equal to 13 cents to the bid offer, all right? Now, if it is a stock that is less than $100, so for instance, if it's XME, we need to make sure that the bid offer 35 days to expiration, because this is where everybody, we used to call this the spot month. This is where everybody's trading. It needs to be less than or equal to 10 cents. All right. So if the stock is less than $100, all right, XYZ is less than $100, then it needs to be equal to or less than 10 cents to the bid offer during open market operations. After the close, things get a little wanky, orders get canceled, but you'll find that generally speaking, that if it follows this rule, that is a green light, all right? If it is two times the rule here, then that's a yellow light, all right? 3 times the rule is a red light. Just stay away from trading that underlying, because the options are too wide. Unless you are a savvy options trader or have a really high risk profile, then you can kind of play with your own stuff. But that's the idea. If it fits my rule of less than, on the stock less than $100, it's less than or equal to 10 cents. That's a green light. 2 times that rule, yellow light. 3 times that rule, stay away from it. All right. Same goes for if we were looking at what is it, NVIDIA, right? NVIDIA, my rule here would be, we're looking at it, we move the decimal 3 ticks to the left, 35 cents, right? So we look down here, and this is after the close, so they're really wide. So they would need to be 35 cents wide from the bid to the offer. after the close, everybody's canceling their orders. So 35 cents, this would be a green light. Basically, if we're looking at 70 cents, that'd be the yellow light, right? And 3 times that, we're looking at $1.21. Or sorry, $1, 3 times would be $1.05. Anything greater than that, right? Is this rate similar to the ratio butterfly? Yes, it is, because with the ratio butterfly, you're adding another put spread to it, right? So Banu is saying, is this similar to a regular, yeah, you're basically in this one, if we're looking at it, we said we're buying a put here, right? We're selling 2 puts, and then we're buying a put. Well, you'd be selling a put, buying a put. So the idea is you're adding risk to the downside, to pay yourself off for the other direction, right? Or vice versa. With the ratio put spread, you could flip it the other way too. All right. So we want the right environment. And I talked about this. We want high volatility. We want high implied volatility. Okay. So what every underlying has its own volatility coefficient, you guys. And when we're looking at that, this is implied volatility. Don't get me wrong. Is that high or low? Well, for NVIDIA, it is relatively high to where it's been in the past. Yes, we did have that massive spike during all of this coronavirus stuff, but if you just drew a line in the sand, right, you can see that NVIDIA's 58.9 is pretty high for historical terms for what it's been in the past, right? So in that case, NVIDIA, I would say, despite the fact that implied volatility percent right now is below 50, which is usually my rule, is above 50 is where we're selling these spreads. But we had such a massive, crazy spike that I think that it's a more of a black swan event, which we get every, 10, 15 years, right? Well, we have to look at where it's been and how often it really spikes that high, and it's pretty rare. So I would say that it has pretty high implied volatility for itself. So look at this chart, make sure you have this on there so that you can kind of relate to where it's at. All right. So we want high implied volatility, and we want that volatility to have the expectations of coming out. NVIDIA has its earnings right now, and we would expect that volatility to continue to come out. So tomorrow, you could set this up with your broken wing butterfly, depending on your market assumption. And as that volatility comes out, it will help us. Because remember, we talked about this, as the market has pumped up volatility in it, like right now, then when that volatility comes out, it helps us because those premiums shrink. And remember, we're short 2 calls that we really want to go to 0, because that will help us much quicker. The duration, we want theta. So basically it's a play. This is the Vega. We want high Vega. We want to get volatility crush. Right underlying, we know that rule, right? Duration, this is having to do with theta. All right, theta. So we want that to go down, right? And we know that theta is at its greatest. I don't know why I had a D in there. Theta is at its greatest, after 35 days to expiration. It starts looking like this. This is theta decay. Inside of 35 days, we get a massive theta contraction. That means we used to call it theta the thief in the night. Out here, it doesn't take very much away from our premiums. But inside of 35 days, we'd see a 50% drop in those premiums right away, which is what we want, right? We want those short calls and that synthetic short call spread to help us out, right? So that theta coming out of this will help us achieve profitability much quicker. So we can see here theta's, right now 36 cents every single night. We go out in time, if you were to do it, 100, 200 days out, it's only 26, or $20. Or sorry, 20 cents a night, right? So an extra 16 cents in these near duration. We want to take advantage of that. 16 to 20 cents actually in these strikes that we're comparing. So twice as much. So, I'm sorry, I got sidetracked. Theta's over here. So theta is about 38. And then we look over at the theta over here, as a matter of fact, and it's only 10 cents. So yeah, 3 times more. You can see it's only 25 there, whereas it's 38 here. So an extra 13 cents a night. Now that's going to add up quickly, right? In a week, we're over 70 cents almost. All right, so we want that to come out of those short strikes, right? That's going to help us. All right, and the strikes here, we talked about this. Just make sure we're doing it for a credit. All right, we need to make sure if we're adding risk to one side, we're getting a credit for it. All right, and our exit strategy. Our exit strategy is going to be that 50% of max profit. We already talked about what the max profit is, right? We know what our max profit is. We only want to get out of this for 50% of that. Don't ride this all the way trying to nail the number, you guys. If you see a 50% of your max profit, get out of it. All right? We're swinging for singles, doubles, and triples. We're not trying to swing for home runs and nail that number. The idea is if the market trickles right to our short strikes, that's going to be right around 50% of our max profit we get out. All right? We've beaten the probabilities and we're moving on. All right? So in the case of our Lulu, if we can go back to our Lulu, right? Does anybody remember what our max profit was on that? Well, I guess we did a couple of examples on it. But let's go back to the Analyze tab. On this particular one, our max profit is the long put spread here, the 55, so $10 and our credit. So $11 is our max profit. Well, I don't want to wait to see this try and settle right at 255 or 245, I mean. If it goes down to 245, that's probably where I'm looking to get out. All right. And that would be when I'm trading around $5.50. All right. So when this is all trading $5.50, I'm looking to get out. We want theta to come down on all of the short legs. Yes. We want the theta to come out of all of it, but it's going to help us the most on these on this strategy for the 245s. We're going to be able to get out quicker. Okay. So looking to get out at 50% of the max profit. Don't try and be a hero, because the heroes end up being the zero. So 50% of our max profit. All right. All right, guys, this is our offer we're giving you guys right now. Basically, you're going to get all of these different courses for $497. I'm throwing this over in the chat window. You guys can click on that, take advantage of it. Like I said, watch this video again. You might be able to find, you will be able to find the broken wing butterfly in here. So you can watch this video for the second time, the broken wing butterfly in one of these courses here. But this is awesome because volatility crush. I probably do maybe a better, more detailed analysis on that volatility crush, which we want out of this strategy. We want that volatility to come out because remember, we're collecting a credit. Anytime you're collecting a credit, you guys, you want that volatility to come out quickly. And that's exactly what we talk about in this course here. Also, if you've ever had strategies go wrong, this will help you sleep at night because you're going to understand the nuances of how volatility, which is really the main driver of pricing, more than theta, to be quite honest. It's the thing that fluctuates that most people don't understand. All right. So that will help you sleep at night. Floor trader hacks will streamline your process. All right. I've talked about probabilities a lot. It will really break that down to help streamline your process. Options basics. If you are a newer trader, even a savvy trader, this will help you remember some of these different things much better. I give different types of terminology, break that down into easy pieces to understand, all right? And also how to trade like the Wolfman, setting up your screen like I do, talk about a little bit more detail about how I'm setting up my option screen, my trading platform, all of that stuff, how to trade options using that market profile that I just showed. You might see on the side of my trading, my charts, it's that blue on the right side. Well, I talk about trading in and around that. So the link here, if you're watching it on tape delay, you're going to have to type this up here into your URL. But otherwise, hit that chat window link, which is the fastest way to get to it. Finally, I want to thank you guys all for bearing with me on some of this that I may have made a little bit more confusing, but I hope you guys understand it. Everybody figure out what I was talking about with a synthetic short put spread in there now. I hope you guys understand that because that's really pretty key to making this strategy work. If we're taking that risk on with that short put spread, we need to be paid for it on the upside. All right. Get rid of that risk. If I'm taking more risk with a short put spread, then I need to be paid off for being for it going the other direction. All right. So thank you guys all. If you have any questions, call us at 310-598-6677. Or if you want to throw out some ideas of different webinars or things to talk about in these webinars, please feel free to reach out to us. And trading at protraderstrategies.com is another way you can get a hold of us as well. Here is the link that you'd have to type into your URL if you're watching this on tape delay. Like I said, over in the chat window is the hot link. All right. So, come on. Todd, you said I'd clear as mud. You're joking, right? We did clear it all up. You can't let me go with that. All right, he's joking. Good, good, good. I think it did get a little murky for a little while, but I hope I acted as a saltwater filter and got rid of all of it. All right. If I have a minute, can I talk about the volatility crush a little bit more? Yes. If you guys want to stick around for a minute, I just wanted to make sure that we were going over, and I know some people are kind of like, I'm out of here. So we'll talk about that volatility crush here a second. But wait, actually, before I get done here, I got to do one more thing, you guys. Yes, it's the disclaimer. There is risks of losing money. Please take a moment to go over this disclaimer. Make sure you understand the risks. I am not in any way trying to solicit you guys to do the broken wing butterfly on Lululemon. All right. The idea is we are finding hypothetical examples to talk about here. All right. So make sure you pause that and read it all over. But here, let's pull up the platform one more time. Wolfman's legal boilerplate. Yes. Mine was the shorter one. Mine's the disclaimer you get at the very beginning. That is compliances. You just saw compliances disclaimer. All right. So volatility crush. How does volatility affect this? Well, we can look at it a couple of different ways. if the underlying traded right here, we can look how volatility going down or up starts affecting it. You can see that the break even on the upside is going to, I'm not going to change my prices here though. That's the thing. But you can see that the purple line is moving higher as volatility starts to decrease. See how the purple line here is making this line move a little bit further down? That's meaning that our prices are helping us, all right? Oops. So as this starts going down, see how I'm getting that that purple line starts moving higher? That's basically meaning you're going into profitability sooner. All right, that's one way to look at it. You know, if I rallied it the other way and made this a positive, right, you can see that that shifts out. So I start increasing it. You can see it's making it harder or pushing down on it. That's one way to look at it. The other way to look at it is we can go over to the trade window and I can throw out theoretical, and let me reset all of this stuff. So the theoretical price is basically right now giving us the middle market, right? Theoretical should equal basically the mark, which is the in-between. All right, so if we don't do anything to price, the underlying doesn't trade, but the volatility, we adjust this number here and say we make it go down by 10 percentage points. All right, hit enter on that. We could see that the one we were talking about buying in Lulu, all right, so basically the one we bought decreased by $3. Let me see if I can try and do this a little bit better. Actually, let's do this. Oh, I don't want that. That was in case my pricing changed too much. So let's go to, what do I want? I want my paint. All right, so let's look at the paint. So right now we know that if we bought the 265s, bought the 265s, sold the 255s twice, and then bought the 245s once, right? Or then did our synthetic put spread and bought the 235s. All right, so we get that credit. So if we're looking at this one where we did the, we bought the 255s, 255 puts, sold two of the 245 puts, right, which is what we did there, and then bought the, what I'm making, I want to make sure I'm doing this right. Oh, 65s, shoot. I knew I was doing something wrong. Don't save, let's start again. 265, 255. So if we bought the 265 puts, right? Sold two of the 255 puts, and then skipped the 245s and went to the 235s, bought the 235 puts. All right. So the 255s, let me try and mess around with this a little bit so we can just see it all. So the 255 puts, or sorry, 265 puts. There we go. I think I got everything lined up. So those 265 puts, volatility decreased. So it basically went from, get everything on here, basically went from the middle, which is 1521. So these were 1521, right? $15.21. The 255s were 1120. And we got two of those, right? So basically that's equal to 2240, right? Because we got to double it. And then the 235s, 564. 564, right? So the idea was that you add these two together, right? And that's our $20.85, right? $20.85 minus the 2240 gave us our equals a credit of $1.54, right? That's our credit, right? Does that make sense? All right. So as the volatility changed, now our 265s are worth $12. So now got our 265s that are worth $12 and what? $12.18. $12.18. Our let's see, the 255s are worth $8.38. $8.38 twice, which is $16.74. So $16.74. You can check me on my math on that one because we're short the two. We're short two of the 255 puts. All right. And then we're long a 235 put, which is now worth, and I'm probably not doing this right. You know why? Because I didn't adjust the price on it. I needed to probably make it go down to the strike 360. 360 there. So yeah, it's going to be the same. $15.88. $15.88. It did get a little bit better because basically we're looking at here as a 86 cents. So you can just see without the underlying trading that now we collected $1.54 and now it's worth 86 cents. So just with that adjustment, somebody can check me on the math on that one. Just on that adjustment with no price happening, but the volatility coming out and no days changed, right? We didn't change any of the days to expiration or days on the thing. Just that volatility adjustment allowed us a better scenario. Oh, 16. Oh, okay. So, you're saying 1676 and 1578. So it still got better though, right? So we got $6.0 there, dollars. So it still got better by 50 cents on that, right? So that's why we want the volatility to come out. Even if the underlying doesn't trade or change, the days to expiration don't change. We basically isolated volatility. You can see how volatility coming out helps this strategy. Even more so if the market, came down to our strikes also. Eric, assuming we are in a bear market, would you not make more sense to simply buying the puts to take advantage of that? Well, if you are worried about the downside, Boris, then we last week did the broken wing call butterfly. If you're not at all worried about the upside, but you're more worried about the downside, you think it's going to be market neutral. You think we're going to stay right here in this underlying, but you're worried about the downside possibly because we're in a bear market, then go check out that broken wing call butterfly because that would be according to that assumption. I'm not trying to say, that this is actually even my assumption in Lulu, all right? I'm just saying that this would be, if I had an assumption in Lulu where we were going to trade sideways, and I think it's going to stay right here. I think really the price target for Lulu is 255 is really what I'm saying. I think Lulu is going to 255, right? But, I sit here, oh, wow. Wait, this stuff has been going crazy. Lululemon, everybody's wearing Lululemon right now, right? Well, I mean, at least maybe guys are too, who knows? But everybody's wearing comfortable clothes because we're all sitting here doing Zoom and GoToWebinar and, Teams and all that stuff, right? Well, in that case, I'm worried about Lulu's upside, not downside. Okay. I'm not saying that that's the case. I'm just saying that that's kind of the idea. We all come up with our assumptions, and that would be something that would be that fitting of that. Oh, you haven't kept me too long, you guys. I want to make sure everybody is clear. And if I made it at all confusing, I want to make sure you guys get this. And, I want to make sure that I teach it in a way that you guys understand, because it may make sense to me in one regard, but you guys might learn a little bit differently. And every course I teach, there's different people in there, and everybody has their own way of learning. So maybe the way that I taught somebody the last time doesn't work with the way I'm talking to this group, right? So I want to make sure you guys get this before I go. All right. Yeah, it's over there. This course is, or this offer is over in the chat window. I threw a link in there. That, if you pop on that link, it should pull up this. It looks a little bit different when you pull it up on that thing, because I can't fit it onto one page. All right. All right, you guys, take care. Make sure you, like I said, go over the disclaimer. Bye for now.